Welcome to today's lecture. In the introduction to foreign exchange risk management, I told you that there are two kinds of hedging method, which is number one, the internal method, and number two, the external method. The internal method, those methods do not require the use of any financial contracts or derivatives. For example, we have the leading and lagging. We also have matching, we have netting, and also foreign invoicing customer in your local currency. The external hedging method comprises of the forward contracts. We also have the futures, options, and the money market hedge. These are the external hedging method. It's involved the use of financial contracts. In the last video, I solved the question on the forward contracts. In this video, I'll be teaching you what it takes to solve a question regarding the futures contract. So what is the futures contract? What is the futures contract? Futures contract, rather, is also a forward contract. For the forward contract, what we did last class, we said the forward contract is a financial contract to buy or sell a specified amount of currency on a specified future dates at a predetermined rate. So the futures contract is also a forward contract, but the forward contract, what we did last week is an OTC contract, over-the-counter contract. The futures contract is a forward contract that is traded on the futures exchange. So the futures contract is traded on the futures exchange. It is not an OTC contract. Basically, using the futures contract to hedge against the fluctuation in the foreign exchange, what you are trying to do is that you're trying to buy or sell futures. And whatever gain you make from the future market, you use it to reduce the losses you make from the cash markets. I'll be showing you how to solve a question shortly, but there are some basic concepts that you need to understand regarding the futures contract. So let's look at some of the definition that you may need to be familiar with before we solve some questions. The first thing you want to know is that the futures contract is not an over-the-counter contract. It is being traded on the futures exchange. Just the way you have the stock exchange, so also you have the futures exchange, where trading takes place on a daily basis. So the future exchange removes the risk of default between the buyer and the seller. So in the futures contract, you are either buying or you are selling. At the end of the day, you either make a gain or you make a loss. So a company that makes a gain will be happy, while the company that is losing will not be happy. And as a result, if there are no intermediaries, the person making the loss may not want to pay. So the futures exchange serves as that intermediary between the buyer and the seller. So the exchange is represented by the clearing house when deals are made. The clearing house serves as the role of the counterparty to both the buyer and the seller. The buyer and the seller buys from the exchange, which is the clearing house. So they tend to reduce this risk between the buyer and the seller. So how is this achieved? The margin. So the parties are not selling any physical item, but they are trying to use the price of the currency that is being traded as a benchmark for making profits or loss. You get to understand this in detail shortly. So the clearinghouse tends to limit this risk by asking both parties to do what? To pay a deposit, which is known as the margin. The parties are to pay these deposits to be able to reduce the risk that the other party may be facing. Okay, so let's look at how this works. Therefore, each party to the contract is required to make a deposit at the inception of the contract. This will cover the loss to be made on the first day of trading. The deposit is called a margin. The deposit provides protection to both parties. So this deposit is called the margin. So on the first day of trade, you're expected to drop a certain sum of money. Let me assume that the company is expected, or the individuals are expected to drop, let's say, $40 each on the first day of trade. So if this is party A, let's assume this is party A and this is party B. If party A makes a loss on the first day of trade, let's assume the loss that party A makes is $35. So at the end of the day, the account will be closed and party A will need to pay party B, that made the loss. We need to pay party A $35. So this helps to reduce the risk. So party B will now be left with $5. Okay, so now let's look at, there are other things that I want you to look at, which is the maintenance margin. So we want to look at the maintenance margin. How much are you expected to have in your accounts as a minimum? So let's look at the word, the maintenance margin and the variation margin. So maintenance margin, this is the minimum amount required to be in the account. So in the first example, the illustration I gave earlier on, assuming the maintenance margin is $40 for both parties. So if at the end of day one, party B has made a loss of $35, and the maintenance margin is $40, it means that party B, we need to pay the clearinghouse $35 to make it $40. So if that is the maintenance margin, so at the end of trade, the minimum balance in your margin account shouldn't be less than $40. Okay, so that is the maintenance margin. So what is a tick? It is the minimum price movement in a futures contract, and it is expressed in 4 decimal places. Now, what are the advantages of the futures contract? Number one, the futures contract can be used to hedge both interest rates and foreign exchange rates risk. The advantages of using futures contracts. Number one, futures can be used to hedge both interest rate risk and foreign currency risk. The second is that default risk is minimal, as contracts are marked to markets on a daily basis by the clearinghouse. So what does this word mean, mark to markets? What does it mean to mark to markets? Okay. It means that the transactions are closed out at the end of every day. Profits are realized at the end of every day, and also losses. So when the transactions are marked to market, you are not waiting till, for instance, you buy a 3-month future, you are not waiting till the end of the third month to calculate the profit or loss on the futures contract. So the profit or loss on the futures contract is being calculated on a daily basis for the clearinghouse to be able to ensure that both parties are protected. Number 3, there is a single specified price, which is transparent. So there's a single specified price, which is transparent, no bid and offer price. So for your forward rates, you have something like bid and offer price, that the bank buys at a particular rate and sells at a particular rate. But for the futures contract, the price is transparent. Remember that also for your forward contract, it is an over-the-counter contract that you can go into the bank and negotiate with the bank. But for the futures contract, it is transparent. There is no negotiation. The market determines the price that every individual will either buy or sell the futures. So for the futures contract, you may have something like June futures, March futures, April futures, and you see the price for each of these futures. You see the price on the exchange. Number 4 advantage, the contracts have flexible closing dates. If I have purchased a June contract, for instance, I may close out this contract even before June, maybe by May. I may decide to close out the contract in May, and profit or loss will be realized. So those are some of the advantages of the futures contracts. So please go through the advantages of the futures contract. Same with the forward contracts and every other hedging method, and the disadvantages, because your examiner may likely ask you to give 1 or 2 advantages of any of the methods that you have used. So take your time, go through the advantages again, and ensure that at least you're able to grab. If you're able to grab all, is good, but if you're not, at least 80% of the advantages. The disadvantages of the futures contracts. Futures price might not move by the same amount as the cash market due to basis risk, and perfect hedge are rare. So the forward contracts, one of the advantages of the forward contract is that it is tailored to the specification of the company. The company can hedge any amount for the forward contract. Company can decide to hedge 200,000 or 210,000 currency. But the futures contract, they are standardized contracts that are in units. So if the price of 1 unit of each contract is, say, 100,000. So if you want to buy the contract, you are buying in units. If you buy 2 contracts, that means 2 contracts will be 200,000. But if your receivable or payable is 210,000, that means if you buy 2 contracts, it will be 200,000. There will be 10,000 naira or $10,000 unhedged. If that is the case, it means that you cannot hedge that 10,000 using the futures contract because it is a standardized contract. So that is one of the disadvantages of the futures contracts. Number 2 disadvantage is the initial margin deposit that is required, and also the variation margin. So you may need to part with some money at the opening of the contract, and also you may need to maintain that deposit till the end of the contract. Futures contracts are not very flexible in this term that they are standardized contracts. So this point number 3 is also tied to point number 1. It is more complex than the forward contracts. So the futures contract is a more complex contract. The forward contract is easy to understand and easy to calculate, but that is not the case with the futures contracts. Finally, futures contract is not available in all currencies. So the futures contracts, they are not available in all currencies. So there are some currencies that you may have a receivable or a payable that you cannot hedge that amount using what the futures. For instance, the Naira is not on the futures exchange. So what are the steps that needs to be observed in solving a question regarding foreign exchange futures? The first thing, there are two things that you want to be looking here. So either for your step 1, the first thing you want to be looking at is 1, there is an exposure. So step 1, you have 2 options for the step 1. You have 2 options for step 1. So it's either you use the transaction or you look at the exposure. So it's either you are looking at the exposure or the transaction. So let me start with the transaction. Let me start with the transaction. So if you have a transaction that is a payable, let's assume you have a payable and the currency of the payable is the USD. And your company, this USD now is the foreign currency. And your company is in the UK. So the currency of your company will be what? Let's say the pound sterling. This is the local currency. So for a payable, what will happen for a payable? The company will need to do what? The company will need to buy the foreign currency. So the company will need to buy the foreign currency, which is the dollar, to make the payments. Is that correct? So there are 2 possibilities here. So if the company will need to buy the dollar to make the payment, so then your decision will be buy futures in the dollar. Okay? But in your exam question, your examiner may decide not to give you futures in dollar. The examiner may decide to give you the futures in the foreign currency. So you say buy futures in dollars or sell futures in the local currency. So if the futures contracts, if the examiner gives you in the dollar, then it means that you should buy futures in dollar. But if the examiner gives you in the pound sterling, it means that you should sell futures in the pound sterling. So a recap again. You look at the transaction to make your decision whether you are buying or selling. You can use 2 things. I said 1 is either I use the transaction or 2, the exposure, but I'm on the transaction. So if it is a payable, it means that the company will need to buy the foreign currency eventually to make the payments. Therefore, the company should do what? Buy futures in the foreign currency. Okay, but the contract currency will go a long way to determine whether the company will finally buy in the foreign currency or sell in the local currency. So if the contract currency in the question is in the local currency, then the company will sell futures. Okay, if it is a receivable, it is the other way around, a receivable. The company will need to do what? Sell the receivable when the money is eventually received. Then if that is the case, the company should do what? Sell futures in that foreign currency, which here we assume to be the dollar, or the company will buy futures in the local currency, which is the pound sterling. So this is how you would determine step one, which is what? Identifying the transaction. So let's use the exposure also. It's either you use the transaction or you use the exposure. But most times it is easier to use the transaction. Students prefer to use the transaction to determine step one. Okay, but if you want to use the exposure, you have two currencies here, right? Which is the dollar, and also you have the pound sterling. Okay, and if this is a payable, you are expecting to pay the dollar in the future. What are you exposed to? What is your exposure? You'll be buying, right? You are supposed to buy the dollar to make payments. Is that correct? So you will be afraid. You'll be afraid that what? The dollar is going to rise. The value of the dollar will rise in the future. So if you're afraid that the value of the dollar will rise in the future, then what do you want to do? You want to buy it today. Is that correct? So if you're afraid that something price will rise today, rise in the future, you want to buy it today. So the same thing here. So here, the same thing. If the value of the dollar is rising, it means that the value of the pound sterling will be falling. Okay. So if you have maybe a commodity and you are anticipating that the price of the commodity will fall in the future, what do you want to do? You want to sell that commodity today before the price falls. So sell. Okay. So the simple summary here is that if you want to use the exposure, you say you buy the currency that you expect to rise in the future, or sell the currency that you expect to fall in the future. For a payable, for a receivable, it is the reverse. For a receivable, it is the reverse. So your fear here will be that the dollar will fall. So if you receive the dollar in the future and the value of the dollar has fallen, that means your receivable value in the local currency will also reduce. So if this is falling, you'll be afraid that the local currency will rise. So once the local currency gains strength, it means that the foreign currency will be falling. So, and if this is the case, we say you buy the currency that you expect to rise and sell the currency that you expect to fall. So you buy and you will sell. So this is just the step one for the futures contract. The first thing is to determine if you are buying or if you are selling the contracts. This is step one. We are done with the step one. Identify that you want to make your decision. These are the steps. So the decision you want to make, you have two things. One, you have to determine whether the company is selling futures or buying futures. So you are either identifying the exposure or identifying the transaction. Okay, so the exposure, we said the foreign currency will depreciate. For a foreign currency receivable, right? For a receivable, what is the exposure? You are afraid that the foreign currency will depreciate or reduce in value. In other words, the home currency will be appreciating if the foreign currency is depreciating. So what is the decision? Before I scroll down, let me see if you're going to get it from my example on the previous slide. So in this situation, what will be the decision for a foreign currency receivable? Are you buying the foreign currency or selling the foreign currency? Okay, I believe you got it. For a payable, the cost of the payable, that's the amount of the foreign currency you need to make the payments. Your fear will be that, oh, the foreign currency may rise, may gain strength against the local currency. And if that is the case, you want to buy the currency that you are afraid that will rise in what? In the future. So for the payable, you want to buy the foreign currency. Okay? So the decision, buy contract in the currency that the company are afraid that will appreciate, or sell contract in the currency that the company is afraid that will depreciate. So that is for the exposure. Okay, so a recap again for the transaction. You want to identify the transaction if it is a receivable or a payable. So for the transaction, the first thing you want to do is to do what? Is to identify the transaction. So for a payable, I said earlier on that when the company receives the money, for a payable, rather, the company wants to make payments. So at the end of the day, the company will need to do what? Buy the foreign currency to make the payments. So if that is the case, the company will either buy futures in the foreign currency or sell futures in the local currency. That's for a payable. For a receivable now, what is the transaction the company wants to receive? When the company receives the foreign currency, the company will eventually sell the foreign currency. Therefore, the company will want to sell futures in the foreign currency or buy futures in the local currency. So let me take this again. For a receivable, the company will sell the foreign currency to the bank when the money is received. Therefore, the company should do what? Sell futures in the foreign currency or buy futures in the local currency. For a payable, the company will need to buy the foreign currency when the payment is due. Therefore, the company should buy futures in the foreign currency or sell futures in the local currency. That is step one. Step two is to determine the transaction dates. So step two is to determine the transaction dates. And how does this help you? It is the transaction date that will help you to know the futures that you are buying. Is it a June future? Is it a March future? Or is it a July future? So determine the transaction dates. The contract to buy to match that date. That is the second step. The third step now is either you use. So let me add to that. Let me add to the steps. So after you determine the futures that you want to buy and the transaction date, you will need to determine the number of contracts to buy or sell. So if you are hedging 300,000, right? And each contract is 150,000. So it means that for you to hedge 300,000, you need to buy how many contracts? You need to buy 2 contracts. So that's step 2. You need to determine the number of contracts. Okay. So that will help you to know if it is a perfect hedge or if it is not. So peradventure, if the contract size is 200, for instance, if the contract size is 200 and you want to hedge 300, so that will be 1.5. In the futures market, you cannot buy 1.5 contract. It has to be in whole number. So that means it's either you overhedge to buy 2 contracts at 400, or you under edge to buy one contract at what 200. So the second thing you need to do or the third thing rather, after you've been able to establish the contract to buy is to know the number of contracts to buy. Then the final step is step 3. It's either you use the lock-in rates. If you are not using the lock-in rates, then it means that you need to do what? Calculate profit or loss. Why step 4 is just to get what? The net outcome. Okay. So let me read the notes down here. Let me take these notes. Okay. So notes, when using the lock-in rates, instead of calculating profit or loss, as mentioned in step 3 above, calculate the lock-in rates. Then use the lock-in rate to calculate the net outcome, and this will be discussed later. Okay. So basically, just know that it's either you are using the lock-in rates or you are using the profit or loss method. So if you are using the profit or loss method, I want you to understand that you may need to know what your gain is. So you have your opening futures price, and also your closing futures price. But we explain this later. Okay, so most of the time in the exam, your examiner does not give you the closing futures price. The examiner doesn't give you the closing futures price. So you will need to calculate what the closing futures price will be using your basis and unexpired basis. Okay, but for now, let's keep it simple. So closing position, what is closing position? What is the closing position? A company enters into a futures contract by buying. That's if a company enters by buying, the company will close by selling at expiration. So if today is 15th of January 2022, and on the futures exchange, June futures, for instance, is, let's just say 30. That's the price, right? That is the price today. That means if I'm buying, this will be my opening futures price, the price of the futures today. Let's assume that today is April 1. So this will be the price of the futures today, which is the opening futures price. Then on 30 June, what will be the price of the futures price on 30 June? Okay. Let's assuming that, let me not use 30 June. Okay, let's use 30 June. What will be the price of the futures on 30 June? Okay, let's assume that on 30 June, it is now 40. Let me just use this simple example, right? So I opened by buying when the price was 30. Now my closing futures price on the contract expiration, closing futures price is now 40. To make it simple. So if you open by selling, we close by buying. If you open by buying, you will close by selling. So when contracts are closed before their settlement dates, that is before expiration, there will be need to calculate what the futures price on the closing dates. So in this example, if the futures are closed before the closing date, we need to calculate what the closing futures price to arrive at closing. You need to calculate the closing rates to arrive at the closing futures price. Therefore, closing futures price is calculated as, okay, so this is the formula to calculate the closing futures price. Closing futures price is calculated as closing spot rates. That's the rate on the closing dates, plus unexpired basis. All this may not make much sense to you now, but just hold on. You gotta get what I'm trying to pass across to you. Okay, so what is basis? you have your spot rate to be the rate for what? Immediate settlements. But on the futures market today, let's assume today is April 1, and the spot rate is, let me say, 1.200. Let me just take this off a little. Okay. Let's assume that the spot rate is 1.2000. It's always in 4 decimal places. So the quotation here is the dollar to the euro, to the pound sterling. So this is your spot rate, okay? That's for immediate settlement. If you want to exchange the currency today, this is what it's going to be. But on the futures price, if you have the futures, maybe June future, for instance, to also be 1.2000, the spot rate here and the futures price here, they are the same thing. That means there is no basis, okay? But if these two are not the same, let's assume that this is 1.300. So the futures market, the price here is different from what the spot rate is today, right? So the difference between these two is what is known as what? Basis. So the futures price minus the spot rate is known as what? The basis, okay? So let's look at the next term that you may need to get familiar with. It's called the basis per month. It's called the basis per month. So there are 3 dates that you need to be familiar with. Number 1 is what? Today. Number 2 is what? The transaction date. And number 3 is the contract expiration. Contract expiry dates. You need to know these 3 dates to be able to calculate your basis correctly. So if today is April 1, for instance, and I expect to receive, say, $5,000 in 2 months' time. So 2 months from April 1 will take us to when? April 1 to May 1 is 1 month. May 1 to June 1 is 2 months. So that means my transaction date, the day that I'm expecting to receive the money is when? 1 June. Okay, so every contract is basically for 3 months. And the closing date for each contract is 31 March, 30 June is every quarter of the year, the last date in every quarter of the year, 30 September, and 31 December. So if I bought a June contract on April 1, it means that that contract will close on 30 June. 30 June. Okay? So if I hold this contract from April 1 to 30 June, there will be no need to calculate what? On expired basis. Okay? So in the earlier question I gave, I said if spot rate is, say, 1.200 and futures price is 1.300. So that means there's a basis of what? If we say opening futures, which is 1.3 minus the spot rate, that will take us to 0.1000. So this basis is expected to be 0 at contract expiration. So if you hold the contract to expiration, the basis become what? 0. But if for any reason you close out the transaction before this closing date, which is 30 June, then that means you need to calculate basis, right? So now how do you calculate the basis? The basis is from April 1. This basis of 0.100 is for how many months? From April 1, which is today's date, to what? Contract expiration, right? So from April 1 to 30 June is 3 months. Okay, for some it may be more than 3 months, or it depends. Some it may be less than 3 months. But just look at today's date and what? The contract expiration. So for this one, it's 3 months. That means basis per month will be 0.1000 all over 3. So this will be the basis per month, right? Which is this basis per month. It is basis all over number of months from today to the end of the contract. Okay, so now what is now unexpired basis? If today is 1st of April and the transaction date is on 1 June, so this is 2 months. That means the basis for those 2 months have expired. Okay, so the expired basis will be what? 2 over 3 times this amount. Okay, so unexpired basis is just 1 month to expiration. You close the contract a month to go. So the unexpired basis will now be 1 all over 3 times this amount. Okay, so whatever you get, that is what the unexpired basis. So using the lock-in rates, how do you now calculate your effective exchange rates? So the moment you are able to calculate your unexpired basis correctly, then you have gotten the answer. The moment you are able to calculate your unexpired basis correctly, then you are good to go using the currency futures. Okay, so this video is just the introduction of currency futures. In the next video, I will be solving some questions to give you a better understanding of the currency futures, how to use it to hedge. If you like the video, please comment on the comment section or like the video. You can also subscribe to this channel if you have not done that. Finally, if you want to get the material for this lecture, I'm going to be dropping the link where you can purchase the book that I'm using to deliver this lecture. Thank you for watching.